if you guys want to speak up, ask questions, I always am promoting that. So all right, I'm gonna go ahead and get going. This is a teaching module I'm going to be using, and you guys can see some of the material we'll be covering here. Some of this we may only touch on once, but I'm sure quite a bit of it we'll kind of try to cover a little bit, almost double, go over a little bit of what we did before, and then move on to the new concepts. And then, as you can see, as we progress, we'll move along to further concepts and stuff. So, real quick, introduction, and then we'll keep moving. So, 2 weeks ago, we talked briefly just about risk management and these introductions. So, we're just talking about what these concepts are. With risk management, we're talking about trade setups, stop losses, and invalidations of a trade. All this has to do with entering a trade with a plan, right? And usually, hopefully, as you progress that plan, you can start building it into actual strategy that you can use as a setup across various stocks or crypto. But if you're entering a trade without an actual trade setup, without a plan, being an invalidation point, a stop loss, take profit, all those things, without having that in place, you're really practicing poor risk management or no risk management. And at the end of the day, we're either DJing gambling or we're trading, to make a profit. And so you got to remember to stay disciplined, guys, to stay disciplined. We talked about candlesticks, just real briefly. Candlesticks come in all different types of flavors, anything from Rinko to Helsinki ASCII to bar. Really, it's a way of visualizing data on a chart. The simplest put, across an x-axis and a y-axis of time. Trade size. We talked generally about how to calculate correct position sizes, and then we talked about margin trading, the pros and cons of trading with leverage. As far as with trading with leverage, we're going to go ahead and just kind of, for simplicity, pile basically any leverage trading into the category of margin trading. I know a lot more of it these days is perpetual futures, where you're not typically putting up a portion of your Bitcoin or something like that as collateral, as in more traditional margin trading, but they pretty much still follow the same form, and same rules apply. Okay, so risk management, trade setup. What you have here is just a screenshot image of a chart. You have a green box and a red box, right? This is an example of a trade setup on a chart. We also have a parallel box drawn here. You can see we were using, and we'll talk about this in just a minute, but we're using horizontal levels, obviously, and when we're speaking about risk management, because we're using horizontal levels as stop losses, entry points, and take profits. So the trade setup is a thought-through plan where you have decided to enter a trade based off of technical analysis. An entry point is where you'll place your order to enter a trade. A stop loss is where your position will be totally closed for a loss of hit. A take profit is where your position will totally be closed for a win. Like, I know some of this is probably a little bit more beginner than some of you guys here today, but obviously, when we're trading futures, if we don't have a stop loss in place, we're basically trading wide open where we can be liquidated. That is like the biggest thing, one of the biggest things that, obviously risk wise when trading with futures, but like the biggest thing you got to get in your head is that unlike spot trading where the price of a crypto or asset moves up and down, and when you decide to exit or sell that asset that you had bought, you're really just it's just the difference whether it's a profit or loss. Well, obviously in futures trading that is multiplied, but an additional factor that comes into that is a liquidation point, and we'll talk about that more in depth in the future. But just real simply, it's a horizontal level on the chart where if price reaches that, it's no longer a matter of a difference in price. Your whole margin is liquidated, so the trade is closed and you've lost whatever margin or If it was perpetual futures, if it was a $1,000 trade on 10x, you just lost your $100. And these liquidation points will always be typically above. Say if we're talking about Bitcoin or something. What I'm trying to get at is these liquidation points will be above zero, right? So these are liquidation points you got to protect. A stop loss is not placed in an arbitrary place. Example, 2% away, but where we're wrong on our trade idea. A take profit is essential in order not to get greedy and to wait for some movement to occur and lose profits, right? So, as we're trading, we always want to be compounding gains, right? And some of the easiest ways to compound gains is to lock in gains consistently over time. And one of the easiest ways to do that, obviously, when we're entering a trade with a trade plan, is exiting at our take profit. As we kind of progress in our trading, I'd like to introduce ideas, especially in future trading. For example, like having multiple take profits, being able to move our stop loss above entry into basically like a risk-free trade. That's kind of something more unique that you get to do in futures trading versus spot trading. And I just wanted to mention a few of those, but we'll go ahead and be working with just kind of some of the basics till you get a better hand of it. Here highlighted, it says a poor entry would be just buying when price is going up out of fear of missing out, emotional trading. And unfortunately, a large part of the majority of retail traders in retail in general is doing something like that. Maybe not emotional trading, but definitely fear of missing out, the old FOMO. And what we're talking about here, some might call that momentum trading, but usually when we're talking about momentum trading and technical analysis, we're referring to something different. Yeah, and there's nothing wrong really with being a momentum trader in technical analysis, as long as you have a trade plan, being your entry point, an exit point as a take profit, and a stop loss. Okay, so summary: trading is a probabilities game in which it's impossible to expect 100% win rate over time. Know your invalidation is before you enter a trade. Knowing where you are wrong is just as important as knowing where you are correct. Always place a stop loss as if it was there to protect you. Always place a take profit as if it was there to stop you from getting greedy and eventually seeing wins turn into losses. Have a full plan for every trade you begin to enter. I think if anything to remember, take away, it's have a trade plan. Besides just having an invalidation point, or if your stop loss is serving as your invalidation point, those are just as important, because you can learn from those just as much as you learn, in my opinion, from your success of when a trade goes your way and it reaches a level, a take profit level. You can gain and learn just as much from where you went wrong, whether it was on your actual risk management for that trade setup, or if the technical analysis you were using in your theory was wrong. You can go back and look and see why, when you were invalidated here on a trade, why. Okay, so now we're going to talk about real quickly the different types of candlesticks. You guys probably know already what this is. This is a line chart, candlestick chart. This is a bar chart, one type of bar chart. And I think I have one more example. Let's see. And then this is wrong. This says Japanese candlestick chart, but really Helsinki ASCII candles are referred to as the Japanese candlesticks, and they're the newest candlesticks. And I'll show you here in just a minute. Typically, compared to your normal candlestick, something easy to differentiate is you'll see these much larger wicks off the top and bottom of these candles. There is a lot of kind of mixed practice and theory regarding candles. It's not so much important as which candles you pick to use your technical analysis, as it is just get in the routine and the habit of consistently using the same candles, right? We're doing all kinds of think of technical analysis as all kinds of different experiments or math problems, but the candles that you're using to do the calculations from and the data. Think of that as like a variable. If you're constantly changing the different candlesticks to do your technical analysis, you're changing a variable in the whole equation, and that gets you really off. So for like the majority of this course and for majority of what I do, technical analysis and stuff like that, I use regular candlesticks because I feel like they accurately portray price better. And so when I'm trying to either do horizontal levels or look at order blocks or things of that nature, I want a normal candle. So how to read candlesticks, I'm sure most of y'all know this as well, but this is real simple. Candles refer always to a given time frame. Every interval of the time frame, a new candle is created. The difference between the opening price and the closing price is called the body of the candle. The highest price and lowest price in relation to the candle body forms a shadow or a wick of the candle. So here's a visual kind of representation of what this looks like. So like was mentioned, a candle body, right, is going to be the opening and closing of a asset's price, whereas this wick is going to be areas where price traveled very briefly. So just like, let's review here. Every candlestick on our chart is going to represent one period of time. So whether we're on a daily chart, a weekly chart, a 5-minute chart, each one of those candles represents that time frame. Summary: candlesticks consist of 4 elements: the open, the high, the low, and the close. These give insights into how price has behaved within a given time frame. The body of the candle represents where it has been most interested during the body of the candle really represents the most volume, that was taking place in that time period, is how I'd put that. The wicks are visualizations of where price attempted to go but failed to remain. Not super hard, nothing to get too, what am I trying to say? Get too stuck on, guys. These candlesticks, and I'm trying to pull up a chart here. So so guys, real quickly here, this is going to be the Dow Jones, and these are, I'm going to try to demonstrate real quickly here a little bit of the candlesticks like we were talking about. So right here, when we're using TradingView or whatever charting platform you use, these are going to be your different type of candlesticks. There'll be a certain point I'd like to start talking about Renko candles and use Renko candles, because I think there's some simple strategies behind that, even for beginners. But for the most part, you want to be using these candles here. You can choose to use hollow candles as well. It's just, your bullish candles are hollow and your bearish are solid. Generally, in most of these charting platforms, you'll see 2 different color palettes, right, representing bullish or bearish candles. And these can take all different forms, but just remember that, we're differentiating between a bullish candle and a bearish candle based on color schematics. And what makes a candle bullish versus bearish, right? Obviously, whether it closes higher or lower than the preceding candle. And the Helsinki-ASCII candles we talked about right here, so I butcher that. As you can see on our chart here, it looks a little bit different than our normal candles, and a lot more wicks. I find this to be a little bit not as accurate when doing technical analysis. Okay, so anyways, jumping back, we've talked about this, let's keep moving. Trade size, and we're going to go into a little bit more of this today. Always know your risk before entering a trade. You must have a setup in play before entering the trade. This is just a simple example here. It says we have a $5,400 account. If we'll risk a 1% loss of the portfolio with each trade, right? So 1% of 5,400 is $54. So then how do we calculate that, right? So we take our trade amount equals our risk amount in dollars divided by our stop loss percentage times 100. So for a trade with a given stop loss of 4% from the entry point, we have 54 divided by 4 times 100 equals 1350. So that tells us exactly where we have our stop loss to give us that 4% risk. We're risking 1% of our total portfolio with a 4% stop loss. To give you a little visual representation kind of what this looks like here, in most of these charting platforms here, you can easily get to this tool here, and I will pick a long projection tool. So for example, if our technical analysis led to the theory that we were going to enter a long on the Dow Jones at this daily candle closure, right? We would pick this on our chart with our tool that we've chosen for a long projection. And then this is how we would adjust our stop loss level, right? Same thing vertically, this is how we would adjust our take profit level. You should only be adjusting that the one time that you draw it on your chart, right? Because we've talked about once we have a trade plan, we stick to it. We don't change the trade plan halfway through the trade. So when you're adjusting this, it should just be you're adjusting it to the levels that we've already come up with. But when we're doing this, this is where we're getting our risk reward ratio right here. So for example, on this chart right here, this risk reward is a 2.89. So almost 2 to 1 risk reward. So meaning that, if this was a 2 to 1 risk reward, it would mean that the upside is double. We have double to gain versus our risk to loss, right? So we would gain 2, lose 1. Leverage trading. Leverage trading allows you to trade with larger position size than what you have available, borrowing the amount from the exchange. What are the pros and the cons? We've talked briefly a little bit about some of the cons. Obviously the pros, you get to trade more contracts than you have. You reap larger rewards when you're right. You can grow your account quicker. You have less exposure if you're used correctly. And taking in mind too that originally, most margin trading, leverage trading was really meant to be used as a hedge, to hedge your larger bet. So meaning you're in a spot Bitcoin position where you're dollar cost averaging, accumulating Bitcoin, going into the latter part of the cycle, looking to exit eventually at some point. Traditionally, right, you'd be margin trading or taking options, say in the opposite direction, using a much smaller percent of your portfolio leverage to cover, to hedge really against. That was the way things were designed, or the way things have traditionally been. Now, obviously, there's a lot more leverage trading that's not used as a hedge. I do the majority of my trading through leverage trading, but just keep that in mind. Some of the cons, obviously, just like the pros, you have larger losses, and you can lose money quicker, just like you can make money quicker. The more leverage, the closer your liquidation price will be, right? And so we'll talk about that again in just a second. And as far as the borrowing, guys, if you guys are wondering how much this, that, and the other, when you're leverage trading, and I would assume the majority of everybody's gonna be, trading perpetuals, we're paying two different types of fees. We're paying basically a funding fee, right? And we'll talk about that in a little bit or at another point. And funding fee will either be positive or negative. So there'll be sometimes even where instead of actually paying a funding fee, you might be getting paid a funding fee from an exchange to keep a position open. And then we're paying an execution fee. We're not talking about large amounts at all. It's very reasonable. I was somebody myself who did large volumes of spot trading, and I found that at times I had $1,000 to $2,000 every 30 days of trading fees in spot. And we'll talk about at some point a strategy how you can really use leverage trading with very, very, very small leverage that covers enough to basically make your trading free. So in a way, it can be very advantageous because you're not spending the fees that you would on spot. So here's an example of leverage trading. So, of 1x leverage trading versus 3x. So 1x leverage trading with $1,000 position size, if the price increases by 1%, we'd be $10 in profit, right? Because 1% of $1,000 is $10. If the price moves 1%, we'd be down $10. Same thing on 3x leverage. We have a $3,000 position size, $2,000 borrowed from the exchange. If the price increases by 1%, we'll have $30 in profit. If the price drops by 1%, we'll lose $30 in profit. What I want you to keep in mind here is both of these positions, the left one and the one on the left in green and the one on the right in red, they both were taken with $1,000, right? Traded with only $1,000, the exact same amount. The reason this says 3,000, right, is this was on 3x leverage. And so just like obviously your position size is magnified or increased with leverage, obviously, your gains and losses, your percentage moves. Using leverage trading sensibly. Going all into one trade indicates poor risk management. Definitely. Simple to remember for starters. Usually what is taught always is using 1% of your trading portfolio or your futures portfolio per trade risk-wise. And also ideally entering trades that the risk-reward setup is a 3-to-1. So even that example that just a few minutes ago I drew on my chart that was almost a 2-to-1 or slightly better than 2-to-1. We're looking for, as a beginning traders, we want to be looking for even better, higher probability setups than that. So, when we're leverage trading, we want to use leverage sensibly. We want to use adequate risk management. Here's a favorable example. Your portfolio is diversified across different exchanges using multiple trading accounts. You have a portfolio worth $50. Let's say 50,000, but only 1,000 are allocated on an exchange. The rest is in another exchange stored in a hardware wallet. You can use leverage to meet the desired position size, even though you don't have the required money on the exchange you want to take for the trade. With the appropriate risk management, you can use leverage to take the trade with the desired position size without moving the funds around. Okay, that sounds real dry, technical. Guys, what does this mean, or how is this like practical? Like simple. Like there's times out there where I think that you can think about where people say their wallets, they get hacked or they get exploited or they're tricked or whatever else. And in this situation I'm talking about, it wouldn't have saved their NFTs, but let's say they're keeping 100K in other assets or coins or whatnot. For example, right, instead of, if you were needing to use that money to trade with, right, instead of having it, especially not in cold storage, but basically having it at risk, let's say 100K, you could just as easily not have 90K in cold storage or a much more secure situation and still trade with 100K, but only be using that 10K and 10 on using 10x leverage. Just an example. Okay, so that was kind of a little bit of what from the prior week. Hope some of y'all are still hanging in here. So let's actually kind of start getting into more meat and potatoes here. Basics, key theory, risk management, trading edge, trading plan. So kind of what we're about to go into, guys, is putting some of this first part together and a little bit of a discipline. So like example of how like I start my day, or a good way for anybody practicing technical analysis, definitely horizontal levels. This will be a great place for you to start. Some of the key notes: always protect your capital. Risk management is the key. Never enter a trade without a plan. Know your invalidations and your targets. Horizontals are very strong and important levels. Therefore, they should be marked correctly on the chart. Always use 2 consecutive candle closes to mark a level. Right? And we'll touch on that more. Support becomes resistance when broken, and resistance turns into support when broken. And we can show you how to visualize this in a minute. Market structure is the king. Develop a daily routine always to do your TA and make a plan before trading. We've talked about that. You'll probably get tired of hearing it. Make a plan before trading. I'm a big fan of market structure and pushing people to learn it, because market structure, guys, if you're able to identify market structure looking at a chart real fast, you'll be so much further ahead, in my opinion, than the majority of people, and you won't be stuck with paralysis or decision paralysis. And market structure gives you a clear it gives you a clear trend as well on a chart, and it also gives you clear levels where, say, once you've identified a trend, whether it's a bullish trend or a bearish trend or a sideways consolidation, it gives you a point or a level that you know in your head, okay, at this point the trend, when at this level the trend will switch or changes, from either whatever it was prior. And so if I can just get you in the routine or in the belief that if you learn some market structure, and I'm not talking about crazy Quasimodo or very advanced stuff. I'm just talking about some simple matters of high, highs and lows and breaks in market structure or changes in character. And if you could just kind of those 3-4 concepts behind market structure, you will start to really become a master, in my opinion. So let's dive into key theory. I haven't seen any questions yet, so we'll keep going. Key theories. 1, trading takes time, everybody. I know it's terrible. Never stop. Nobody got to where they are now by only working, at it 50%. Don't expect to become a professional trader and only chart 8 hours a week. You get there after you get to that point, and then you're called an investor, and you get to that point by being successful, by working hard, doing all the right things. Losses are normal in trading. Keep going. You need to put in the time and accept losses to learn from them. On average, 3 to 5 years is the amount of time required for a trader to become profitable. Now, I'm very optimistic for anybody watching this or listening, because I feel like this statistic is maybe a loner at home with a book. We're a community here, we're very involved in everything else, and with the right support, I think that in a little bit of time that anybody that's applying themselves really should find themselves profitable within 6 months. I'm not saying that they'll have it all figured out, but you should definitely be profitable 6 months in, assuming you're not taking too many trades. Let's talk about key theory here. Not a get rich quick scheme, right? We got to hit you with all the boring or don't get your hopes up stuff, right? So that then we can really kind of blow you away. Don't focus on the small term picture, but rather long term vision, right? Trading is about longevity and top risk management. Long term vision must be of staying in a consistent gains over time. Time and time again, I talk about systems, and I used to never understand or correlate a lot of the professional poker playing and also traders, technical analysis. But you guys, it's all about like a system, right? And compounding that system. So in any system, right, you have to have consistency. It's like a formula. Whether you have a system for playing slot machines, right, or a system for playing poker, typically the house is against you, right? And so over time, the more times that you play, statistically, your chance of being profitable is going down, right? So same thing. So people count cards, people do all kinds of things, right, to give them an edge, to give them a little favor. We're doing kind of the same thing in trading, right? We're not, but we are being very practical and systematic about our gains and about our risk management. The risk management is really, really key. I'm a big fan of ICT kind of concepts or smart money concepts trading. And there are a lot of critics out there that say that, that school of trading is only so successful is because of the risk management behind it. Well, okay, cool. So here's an example of just a little idea, looking at different trading accounts to give you an idea of someone that's trading like with 2% versus 10%, and to show you the difference. Let's say one trader risks 2% of his account on each trade, while the second one risks 10% of his account on each trade. If each trader has 10 losing trades in a row, the first one will have 16,675 left, while the second will only have 7,700 left. You guys, like, this trading is like war, right? And our dry powder is our capital, right? Our money. So you gotta always have some for the next battle, the next fight. You gotta have something to be able to obviously make your next trades, right? I mean, so that's why, once again, the risk management. This mentions Binance has a feature of scaling the trade size 25. Your most common platform, Binance, Phoenix, a lot of them. They have these 25, 50%, 75% default buttons you can hit. Same thing with take profits. And a lot of times you'll see a 10%, a 25% type thing. But yeah, so that's that. Always know that the risk before you enter a trade. We've talked about that. We'll talk about that. We'll look at that in a minute. You must have your setup in play before entering the trade. 1% is not the trade amount, but the risk we should lose the trade. The biggest loss we'll ever take is at maximum 1% of the portfolio. So, flashback, guys. When we're talking about 1% risk, right? Each trade out of your portfolio, we're hoping that, with the idea that none of those trades ever get liquidated, and it's not a complete loss of 1%. And that's where the power in that is. So we'll take trades, right, where a stop loss might be 5% or 10%. And the beauty and why all that works and the system behind that is because even if we got that trade completely wrong and lost all our money and got liquidated, it would only still be 1%, right, of the total futures account. It wouldn't be enough to really knock us off. So just keep hammering that home. This method is good for low balance accounts, 100,000 or less. If you're consistent, you scale up to 2%. If you're a beginner, start even with, you don't even have to start with 1%. It could be 0.5%. You should never take a trade with less than a 2-to-1 risk ratio. Better, more, equal to 3-to-1. I was talking about that briefly just a minute ago. Make this chart better. So let's see, what would a 2-to-1 risk reward setup look for us? Let's go. So this would be generally about a 2-to-1 risk reward setup here. And although that, obviously the rewards double the risk, this still is not, what beginners should be looking for. We would want to be looking for a trade setup that was 3-to-1. So that doesn't mean that, let's say that for some reason, and we're about to start, bear with me, guys, we're about to start drawing horizontal levels. But let's say that for some reason, you thought that the low was going to be here at this level, right? And so you actually have a stop loss that's just under that level, and you think that this was a good trade setup. Now, guys, obviously before we go in, and I'm going to do this with y'all here in just a minute, drawing horizontal levels. But before we actually plotted our long theory right here on the chart, we want to have these levels marked, right? So if we thought that this was, for whatever reason, support, or the low of a support, right? And let's say, what we were doing here was something crazy. And we took, something like the fib extension. Anyways, and we were looking for, we thought this would be a good take profit level, right? And this is where price is at. So when we come here to plot for risk reward and our long or short, I'm just going to go with where price is at right now for the demonstration of this. But so if this was our long to short setup here, we'd want to then obviously drag this to match our levels, and then this is where we get an idea of our risk reward setup. As you can see right here, this is basically a 1-for-1, or actually 1 to 1.02, but 50-50 more or less. But same thing, if we were doing this and our trade setup was 2 to 1, that wouldn't be a good. We'd pick something else. We'd find something else to enter. We'd be looking for 3 to 1. And once we get through this first whole module 1, I'll start practicing some of these throughout the week with you guys to maybe show you what they look like, or at least try to find some and put them out there in the Discord. One thing I wanted to mention, just when doing, once you've come up with a trade plan and then you're actually plotting your risk reward, and you can calculate it, guys, too, and there's different calculators and stuff like that besides just drawing it visually. But what I wanted to get at is, it doesn't mean that let's say that this was our, okay, never mind. Okay, let's say, okay, so this was our trade plan, right? And well, this doesn't give us the risk reward we want, right? It doesn't mean that we just simply come over here and then adjust our setup basically to give us a 3 to 1 risk reward. That's not what we do, because the only way that you'd either have to move your take profit up, right, or let me show you, or I'd move my stop loss up until I got to a 3 to 1, like so. And why do we not do that? Because just like our risk reward trade plan, we don't change. Same thing with our levels, right? For invalidation and take profit, these are levels we picked on purpose, right? So as we put this together, we're going to mark our horizontal levels. We'll look for good trade setups once we found support, resistance, trend lines, and then we'll be drawing our position on the chart to look at our risk reward setup to see if it's worth entering the trade. Way more than we enter, we need to pass on different setups. We need to, draw technical analysis. The beauty is, guys, you can save your charts. So at another point in time, we can come back, we can look, and when it's at our level that we've made our trade on or idea on, we can take action. So I'm having a lot of distractions in the background today. Longevity is the key. If your risk on any given position is small relative to your total capital, then you can take a losing streak, right? So, guys, if we're trading with 1% of our portfolio each time, right, you can get quite a few wrong, even in the beginning in a row, and still be okay. And that's why even more, for anybody beginning, the smaller position size or the smaller percentage of your portfolio, the more important. There is no best way to trade. There's no right or wrong way to trade, only a way that works for you. Pick an area, master it. So, whether you're a swing trader, a scalp trader, crypto, stocks. I put on here, don't practice crypto and then start investing gold. It's just kind of a joke. Crypto, guys, right, is a very high risk asset, but it's also very highly volatile, right? Meaning that the price moves up and down, it fluctuates, and it moves fast. Gold, on the other hand, traditionally the price doesn't move very fast. It's not nearly as volatile. You actually, and small note, I don't know if you still can. You used to be able to trade futures in gold on Phoenix even, but to give you an idea, like you'd almost have to like trade it on 100x to be worth your time because of the volatility symbol, or just have a long time range. And real briefly, guys, sometimes like us traders and other people like making calls, like there'll be typical kind of verbiage or nomenclature we all kind of use. We'll call something a swing trade or someone a swing trader. Typically that's a trade that's going to go for several hours or days, right? Typically days, I'm sorry, or which would be something like a trade once a week or maybe once or twice a week. A scalp trader, right, is definitely more of a day trade, right? It's probably going to take place over a couple hours, maybe 1 to 2 days at the max. And so just keep that in mind. Time frames, when we talk about time frames, you'll hear a lot of high time frame, low time frame. Simply, what does this mean? Simply, this means that the smaller the time frame, the faster. So a small time frame would be something like a 5-minute, a 15-minute, a 1 hour is even a lower time frame. Higher time frames are typically your 4-hour, your daily, your weekly, your monthly levels. And so just keep that in mind. And as we're practicing, and we're going to start marking out horizontal levels, especially with horizontals, there's key levels on high tie frames that we should always stick to in practice and be in our monthly levels, our weekly levels, and our daily levels. And I'm kind of going to give you an idea of a little brief how I look at things and start my day and check charts, and kind of something for you to practice as well. Yeah, you guys, I put on whoever says that they don't never takes a loss, they're a liar. Yeah, anybody that's out there trading for a living and stuff like that, you lose trades. So you do. No shame in it, no shame. Have a plan. Know you're going to get out of the trade before you get in it. Stick to your plan always. Treat your trading methodology like a business. Simple, effective, rememberable. If you have a profitable plan, but then you take a losing streak, you can adjust it. Just don't think that plan is totally a failure. Plans do not need to be complicated. Always ask, is this increasing profitability or reducing risk before adjusting your plan, right? So we're not talking about once you've already executed and you're in your plan, but we're saying as you're sitting there drawing on your chart, looking at different things, looking at different metrics, indicators, and you're maybe starting to adjust your levels of what you think is realistic for either invalidation, stop loss, take profit. Just kind of be asking in the back of your head, is this increasing profitability or reducing risk? A real kind of simple practical example, right, even of that would be like to give you a visualization. Say if we're looking on a chart, right, and this was my trade setup, and I had my stop literally just right at this horizontal level, at this right line, at this 37,373, and this was I was keeping my stop right under there because that was my level that I thought was invalidation or would serve as support. An example of what I'm trying to say is like keep in the back of your head what you're doing if it'll affect anything. Would be like I'm looking over here and I see that on a daily level that these previous candles, right, had actually closed, or really closed, let's say even closed above here, but the wick still came down, right? As I was sitting here adjusting, looking, thinking about a trade plan, if I was thinking about lowering my stop loss, right, why would I be doing that? Would it be increasing my profitability? Would it be reducing my risk? And so be thinking about those things, because, for example, here I could be reducing my risk, right, by moving my stop now below the wicks of these previous daily candles here on the chart, which would be in theory less probable that I get stopped out, right? So maybe increasing my probability of my trade being successful, but at the same time, I am increasing my risk, but by moving my stop, because that's just a further point down that I'm placing my stop loss, so a higher risk point. If you go on a losing streak, don't keep trading. Take a break. Don't revenge trade. Increasing the amount of money trading, instead reduce it. Reduce the risk to 0.5% if you were at 1%. I would say very, very important, and still something even I find I struggle with these days. As we're sitting here leverage trading, because we can very easily increase our position size by simply just changing our leverage amount, right? i.e. borrowing more. It's just much easier to find yourself taking a revenge trade. And what would that look like? For example, you decided to go 5x long on Bitcoin, and 10 minutes into it, you're getting smashed. You realize like your trade plan was completely wrong, and you just lost $100. Well, you might tell yourself right there in your head, well, this is stupid. I know that I was wrong. It's obviously going the other direction. So instead of 5x, I'll just 10x this next trade, and I'll make the money back, no problem. I'm telling you, the minute you start doing stuff like that, it gets ugly. You'll get shot. You really, really do. And that type of thing is a momentum in itself. You get it wrong, and then you overcompensate, and you get it wrong again, and you overcompensate. And that's why it's just important. Just you get it wrong, take a break, whatever. We're not risking 100% of our portfolio each time. you should always feel like there is another day, there is another chance. For anybody like really at home trying to become a day trader, man, exercise. Use exercise as a break. Get up, go for a walk, like clear your mind. There's many things that I feel like will come to you while you're not sitting here staring at a monitor or sitting stressing, figuring out how you're going to, make your next win twice what your previous loss was. And real briefly too, guys, over trading is a real thing. I myself even struggled with it at times. Like over trading, 100%, even with proper risk management, trade plan, everything, you definitely can over trading. And at a certain point, it gets to be ridiculous. You could argue a rationale that you're using such tight stop losses and it doesn't really matter, this, that, and the other. But just like having a system of winning, a system of losing, even if it's just execution fees, be it $2 each trade, you're taking 10 of those a day, so you're 20 and times 5 days a week, soon as you could be 120 negative a day without even really realizing it, thinking that you're just taking simple trades, $2.